Hi guys, today we'll be talking about mutual fund. This is one of my favorite topics. What is a mutual fund? A mutual fund is actually when people come together, investors. And you're probably thinking, I'm not an investor. Yes, even with your 1,000 naira per month, you are an investor. So investors, this is when all those different investors, they pool their money together. That is you and I and other people, we all pool our money together. Then we hand it over to a fund manager. A fund manager is an expert. This person went to school or studied how to manage money. The fund manager is the expert that we're actually giving the money to. Now, this expert invests it in securities. What are securities? Securities are assets. They're investments. So it could be what? It could be shares. It could be treasury bills. It could be bonds. It could be real estate. It could be anything. Now, this securities then does what? It generates a return. Now, you must remember, a return could be a profit or it could be a loss, meaning that it could go what? Either ways. Now, this returns is then passed back to the investors. Now, you can see the circular movement, right? So the investor, we all pull our money together. We give it to a fund manager. The fund manager invests it in securities. We now get returns and then the money comes back into our hands. If we want, we can put it back and continue the cycle again, or we can just take our money and go. So that is what a mutual fund entails. There are different kinds of mutual fund. What actually defines a mutual fund is what it invests in. Now let's think of it like rice. You have jollof rice, you have fried rice, you have coconut rice. What do they all have in common? They're all rice, but what makes them different? For jollof rice, you're putting it inside what? Tomato sauce. For coconut rice, you're putting inside coconut sauce. For fried rice, you're putting inside vegetable sauce. The same thing with mutual fund. What they all have in common is that people are coming and putting their money together. But what differentiates it is what they put that money into. Now, if majority of that investment is treasury bills, you are dealing with a money market mutual fund. A money market mutual fund usually wants to invest in something that is safe. So about 75% of it could be treasury bills. They could have some fixed income instrument. They could have some commercial paper. But the bulk of that investment is in treasury bills. Then you call it a money market mutual fund. What is the difference? Now you're thinking, Tosin, you've already talked about treasury bills and now you're talking about a money market mutual fund. What is the difference between the both of them? For a treasury bill, it is a treasury bill alone. When you enter the position, you can exit if you want to exit earlier, or you can wait for the duration of time. But for a money market mutual fund, the majority of the money is invested in treasury bills. You can add to it anytime you want. So you can put some money on the 1st of January. You can put some more money on the 15th of January. Do you understand? You can treat it like a savings account. You can just keep tip, 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 tip. You can keep pouring inside of it. That is the key difference between the both of them. So now, back to the money market mutual fund. We already said that majority of that fund constitutes of what? Treasury bills. And then it has some commercial paper and sometimes some fixed income instrument. That is a money market mutual fund. They always optimize for what? Safety. They want a situation where as you can sleep at night, you're not taking too much risk. It works like a savings account, but with better interest. So guys, please stop leaving your money in the bank. Take your money out of a savings account and put it in a money market mutual fund, because it gives you the safety of a savings account, and also you also have flexibility, meaning that depending from companies to companies, there are some companies that can help you cash out within 5 working days. There are some that will give you your money within 3 working days, and some might even give you in a shorter duration of time. I hope you found that helpful. Now let's talk about another mutual fund. We have here the equity mutual fund. Hi guys, we're here to teach you and talk about the equity fund. So what is an equity fund? As the name implies, equity means shares. A share is a slice of a company. It's a part of a company, right? So this fund actually invests in the stock market, invests in equities. Now you're probably thinking, what is the catch? There's actually no catch. It's a different kind of scenario altogether. So an equity fund invests primarily in shares. Remember what we spoke about, even when we're talking about the money market mutual fund, at least majority of the fund here should go towards equity. I'm looking at about 75%. Another portion can have some in cash sitting. You could also have some in fixed income. Fixed income in this case will be something like government bills, treasury bills, and things like that, right? And it could have a composition that looks like this. Another key feature of an equity fund is that you do not own the shares. What is happening here is that the asset manager is actively managing the share on your behalf. So for many people that do not really understand much about the stock market and they still want to get an exposure into equity, this is a good option. So this person is waking up every day and looking at the movement. So where's the financial stock going? What's happening in the economy? How should we readjust the portfolio? They're making decisions on your behalf. So how do you profit since you do not own the share? What happens is that if they make a profit or if they make a loss, everybody gets to share in it. Let's bring it back home. Let's say this particular fund makes a profit of 3% and I invested 100,000 naira. What happens? You get 100,000 naira multiplied by 3%. So you get your capital plus the interest, which is the 3,000 naira. Now, it could also go the other way around. So in as much as it could have profit, it could also make a loss. If this fund here is at negative 10%, what happens? You take 10%, multiply it by 100,000, which is about what, 10,000 naira, and fiam, your capital gets slashed. So you only be getting 90,000 naira back. Now, these are examples. It could go what? Either ways. Now, look at this beautiful pot here. For the purpose of this example, we have something here in Dangote Cement. You're exposing yourself to industrial stock. We have something here in Nestle. This is our consumer goods. We have here MTN, which is telecom. We have here GTB, which is what, financial services. And then we have some fixed income and we have some cash. Again, we are just making an example. So your fund manager will help structure your equity fund, taking into account risk, exposure, what market should we be in, what share should we choose, and they actively manage it. Do you know that the Security Exchange Commission actually regulates mutual funds? So in this case, an equity mutual fund, they regulate it. So that way, this asset manager firms actually have to report to the SEC, that is the Security Exchange Commission. Now, we've seen our beautiful pot and see what all it entails. I've already told you that a portfolio asset manager is the person that manages it or the institution that manages it, and you do not own the share. You can profit in an upside, you can profit in an upside, you can also share in the losses. Now, how will I know if my equity fund is performing well or not? That is a very good question. There's something on the Nigerian Stock Exchange that is called an all-share index. How is it spelled? ASI. Have you ever listened to the news and they'll be like, Nigerian Stock Exchange went up by 4% in a day? Exactly. That is an all-share index. So in layman terms, what is an all-share index? Now, in Nigeria, we have about 199 stocks on the Nigerian Stock Exchange. They bring all these shares together. They look at their market sizes. They do a math, which is called a weighted average analysis to see how all the shares moved. Then they get a number. That number is called the all-share index. So they can see that on average, you know how averages work. Somebody can get 10 over 10. Another person will get 5 over 5. You want to look at the both of them average. What will you say? Is a 7.5% average. Exactly. The same thing happens on the market. You look at their market sizes and then you calculate your average. Now, that's how you know how your all-share index is. Now, back to the question, how do you compare your equity fund to know if it's worked out well or not? You will look at how the entire market performed, which is what the all-share index measures. Now, if the all-share index is measuring, for instance, if it's giving you, for instance, a 4%, and your equity fund is giving you 1%, they have performed poorly because they are lower than the benchmark. This is your benchmark, your all-share index. So every time you look at what the all-share index is performing on average, your equity fund should, at the very minimum, match it. If it performs lower, then maybe not so great. All right, so what else do we need to touch here? We've spoken about the portfolio asset manager. We've spoken that you do not own the share. You've spoken about how we have a benchmark. Another question we get a lot is tossing. Should I buy an individual share or should I invest in an equity fund? Meaning, should I just own the share? Because remember, with this, you don't own the share. You share in the profit or the loss. Or should I just buy my own share? I always tell them, listen, this is what could happen. For instance, if you look at Amazon in 2017, it delivered 56% in that year, that is in 2017. Whereas the composite index, which is similar to like the all share index in Nigeria, delivered what? About 15.81%. You can see the massive difference there. Now, guess what? In that same year, there are some companies that lost over 20%. So you see, what equity fund does for you is that it helps you manage a basket. Do you understand? Because it's diversified. It offers a diversification, which an individual share will not do. So if you choose to go and invest in individual shares, make sure that you also buy other ones, so you are diversifying your what? You're diversifying your risk. I hope you found this helpful. Get into the comment section. We're here and we're ready to answer all your questions. Thank you.